Hi everybody, Joe Conroy, Hartford Retirement Planners. I hope you're doing well. I hope everybody is healthy. What we want to do today is explain a little bit of some context and thinking around market volatility. So me, Steve, and Mike, we're all going to go through some of our favorite charts, helping make sense of volatile markets. We really haven't had much of a volatility since COVID up until recently. So if you would, try to focus on the messaging here and not my bright, loud sweater. The chart that I'm going to go through is looking at bear markets going back 96 years. So over the last 96 years, the S&P 500, again, just an index, it's not a diversified portfolio, it's not a recommendation, but when we look back 96 years, we've had 11 bear markets. A bear market's a 20% drop or more. So what can this chart tell us? Well, some of the things that stick out to me is it shows you the average amount of time for a bear market. So when the market's dropped 20% or more in the past, it's lasted on average about 1.3 years. In the grand scheme of your overall financial plan, in the moment it might seem like an eternity, but when we're looking at gearing up for and staying in retirement, because remember, retirement is just a checkpoint, it's not the end of the race, right? It's just a speed bump. It's a little blip on the radar, 1.3 years. You know, what we're doing with portfolios is making sure we have other assets so we don't have to sell stocks in the middle of a down market if we can avoid it, right? It's the purpose of diversification. But let's take it one step further. So an average duration of a bear market is about 1.3 years. What does it look like if we hold tight and we don't panic sell at the bottom? What's waiting for us on the other side? So if we look at this chart, what we'll see is 1 year on average after a bear market, 48+% recovery, right? So that's a rebound of 48% within just 1 year on average of a bear market. Stretch it out 2 years, it gets even better, 68% plus is waiting for you on average in the past. Not a guarantee of future results, but those are the sunny days, the bright days ahead of us if we can just handle some of the volatility as it happens. So, only 11 times the market's dropped 20+% in the last 96 years. On average, around 50 to 70%, 1 to 2 year recovery rate, right? So that's the chart I want to go through. I'm going to go ahead and kick it over to Steve and he can explain his chart.
Hello everybody, Stephen Maxwell here. What I want to talk to you about today is market timing. So the illustration I have in front of me and the one that should be on your screen shows a 20-year look back of stock market performance. What we want to talk about when we talk about market timing is not necessarily market timing, but time in the market. It's being able to weather the storm when the markets are down so that you can be a part of the markets when they begin to increase again. What this slide shows is it's very difficult to predict market performance. And if you do try to time market performance, it can often be very dramatic as far as your rate of return goes in your portfolio. That means in a down market, we all need to be patient. Because in this slide, like this slide is depicting, over the past 20 years, we see 25 of the worst days are subsequently followed within a month with 25 of the best days in the market. This is really important because if you miss out on the best days in the market and you're in for some of the worst days in the market, you're obviously going to have very dramatic difference in your returns. You can see on the right side, it shows almost a 5 times increase if you stay in the market through both the high and the low days versus trying to time the low days. This is why we say it's very difficult to time the market, and we don't try to do it here at Hartford Retirement Planners. I'm going to send it over to my buddy Mike, and he's going to go through one more slide with you.
Mike Crumley here. I'm going to walk you through a chart on diversification. So let me explain this chart and what we're looking at here. So each column is a year in the market, and each color represents this different asset class. So let's take 1999, for example. Let's look at the top. EM Emerging Market was the top performing asset class, 66% rate of return. So if you just went ahead and invested all your money in emerging markets after seeing how well it performed in 1999, you'd be disappointed in 2000. Negative 30% rate of return. Lowest performing asset class in the market. So as you scan through the chart here, you'll see there is no pattern, there's no rhyme or reason, there's no predictability about how each asset class is going to perform. So now let's draw your attention to these black circles around the middle of the chart. So these represent a hypothetical diversified portfolio. It's never going to be all the way at the top, but it's also never going to be all the way at the bottom. And what we're trying to show here is that the diversified portfolio smooths out that ride and hopefully gives the client a better investor experience. So I know diversification is not a new concept. Hopefully this just proves why it is such an important part of our overall strategy.
So hopefully you found this video helpful and help kind of add some context as we see a lot of headlines and things in the news. Those are our thoughts on market volatility. If there's anything we can do to help clarify your individual picture or explain things in more detail or maybe answer some questions that we weren't able to get to in this video, please feel free to reach out to us. We welcome the opportunity to help. And as always, thank you for watching.